Yeah, I'm losing my edge.
Today, though, Michael, let's talk about managing pairs trades. This is going to be a tight segment here, which is fine because it's not going to be that crazy. A lot of people think about pairs trading markets, which is essentially just taking a market and then taking its good friend, its buddy, and then trading those things in opposing directions against each other. And now you've got a new trade, as opposed to simply trading United Airlines alone and being like, I'm buying or selling this stock. You can trade United Airlines against American Airlines because you think you have a hunch, you have some kind of edge in one of them outperforming the other. And that creates a pairs market. And a lot of people, when you add that second step, it's similar to, going from futures to futures options or stock trading to stock options. And I'm not saying this is wrong or a bad thing, but a lot of people, they tend to lose their minds. They're like, oh my gosh, it's a completely different world. It's crazy. I have to come up with a bunch of different mechanics. But at the end of the day, Michael, a pairs market has a price that goes up and down the same as just the primary singular market, right?
Yeah, it took me a long time to grasp this concept because kind of the classic example is, you read it on Investopedia or something. It's United Airlines, American Airlines, or Coca-Cola and Pepsi. Those trades are really expensive to do. The more capitally efficient
Sport peppers and celery salt, yeah.
Yeah, trade the divergence between those two. Yeah, a great hot dog right there. The more efficient way is with futures. Unfortunately, comes with a lot of complexity because of the notionals and the tick sizes. But when you reframe it as, hey, it's just another price. It's the deviation between two products, some ratio of the two, just another price. It's the same trading mechanics as you would see in an outright.
Yeah, and I want to start dipping into that compare and contrast to the outright, and especially with small exchange products, it makes trading stock markets against each other very simple because our STIX product is around $50. Our SM75 product is around $50. They both have the same minimum tick. They both have the same notional value. You trade them one for one. They look very similar, and so it makes trading the broad stock market, SM75, which has technology stocks, but also energy, industrials, materials, and financials against just technology stocks, which is that STIX product, makes it very easy given all those details. But let's move past those details to get into the actual trading, because speculating on a single market for us usually centers around what's the normal day and how do I create some edge and some trade ideas around that. And moving forward, Michael, it's a little trickier when you're trading a relationship versus just that one market. Trading STIX relative to trading STIX versus SM75, a little trickier that we'll get to in a second, but kind of how you eloquently nailed there. This difference here, we're looking at it in percentage, so not necessarily a price value, but buying or selling this blue-green line, which is STIX, that resulted in currently a 30% year-to-date return, is, in my mind, and I know I've seen this a lot more than maybe someone who's new to trading, is the same as what would be just a new line, which is the blue-green minus the yellow. And so you see here, that line would have been 0% here because there's no difference, but the difference grows to about 5-10% here in February. And then it starts to widen. And now the difference between these two is its own market. It's a relationship market that is a little bit trickier, like I put here. But at the end of the day, it's once you get over the hump, it's not that tricky anymore. It's like, Michael here plays a couple instruments, one of which the ukulele. The first time you learn a certain chord progression, you're kind of like, this is insane. I'm never going to get my head wrapped around it. And then you look at it 10, 20 more times, and you're like, oh, it's the same as everything I've ever done on this instrument, but it's just a little bit more complex, and now I understand it. Same for pairs trading here, right?
Yeah, the same form, you got the beautiful sound, everything kind of works together nicely. And I love the way you framed that, Frank, it's a new market almost. I mean, one of the reasons I love pairs trading, and there's such an integral strategy to a lot of professionals as well, is you create a new view of opportunity. You may think that STIX is kind of middling in its range, or maybe stocks are middling in their range. Now pair them next to each other and you have completely new exposure. and adding that long short position, you're not necessarily long SM75 or short STIX. You're just trading that deviation between the two.
Yeah, you're long that new market. It is quite literally like going back to our first example here. If you looked at, the 10 or 20 airline stocks that are prominent here in the US, and you said, okay, I can buy or sell these 10 companies. So I, in theory, have 20 trades that I could do, right? But when you start to think about how you can trade one of those against any of the 9 others, and then you can trade the other one against any of the 9 others. Now, all of a sudden, instead of 20 permutations of a trade, you've got hundreds of permutations of a trade. So it's simply just widening your horizons, especially when a stock market is middling. And, there's, for instance, the broad stock market here, SM75, or if you want to think about S&Ps or Dow, for example, they've been wrapped around unchanged for the last couple of months, not really moving anywhere. But when you open up that toolbox to more permutations, when you take all of the current landscape for stock index futures, STIX, SM75, S&Ps, Dow, Russell, NASDAQ, that's what I'm forgetting, and you open up those 6 indices to trading them against each other, you've got now 6 indices that in their own right I don't really have an opinion on. They're all hugging unchanged. They're not moving anywhere, but look at this these 2 markets here contract, and then this freaking Slack thing, and then expand here, and that creates new trades that, as recent as Monday, have been interesting. On Monday alone, I bring this up because pairs trading has been exceptionally interesting the last couple of weeks. Looking at stock markets, on Monday, you saw a divergence, Michael, around 1:30 in the afternoon of a full percentage point of STIX over SM75. And that is a big move. And we'll get to some numbers in a second, but that is a big intraday move. Came all the way back by the close. You go to Wednesday here, just yesterday, and you see a huge divergence of, once again, a percentage point, the opposite direction. SM75 is now performing better than STIX. And so you look at these 2 charts, okay, Michael, and you've got these 2 stock index futures that on Monday closed inside day, didn't really go anywhere. They were up 1/4 of a percentage point. Yesterday, SM75 didn't really go anywhere. The technology got hammered, but SM75 didn't really go anywhere. But with those inside days in 3 of these 4 trading examples, you have huge moves and great trading occurrences in the pairs markets. And that's what you're looking for, right? Like, no one who's trading, or if you're at the grocery store or whatever, is ever like, I don't want more options. I don't want more things to potentially make money off of. So adding pairs here it definitely gives you more opportunities, like we've seen just as recent as Monday and Wednesday.
As recent as even today, Frank.
Today?
Well. In the Big Movers morning segment that we shoot, I highlighted this divergence because the SM75 was down pretty huge, and it's actually reversed some of those gains. So definitely, keep your eyes peeled on these opportunities. The math is so simple in these 2 products, one minus the other, both trading around $50, that it's not a huge algebraic equation to compute your profit and loss and what's insignificant or insignificant difference between the 2.
Absolutely. And the only number crunching that you really have to do is, you and I keep using these words like, huge divergence, or, came back to, and so people ask these questions like I posed in the slides here, when do you initiate and when do you take profits potentially? And guess what? I crunched the numbers for you here. And we found that these pairs markets in the equity index futures, they move about half of the outright markets. So whether you're trading short term on a daily basis, and you're used to, $1 give or take an SM75, about 2% move on a daily basis, I would look for half of that in the spread markets. And so whatever your mechanics are for trading outright equities, I would attribute those to the spread markets, but just cut those expectations in half. Same with on a monthly basis, you're seeing this movement cut in half as well, which is a great selling point for why you should trade pairs, because they are traditionally, if you have 2 markets that are highly correlated, they move less and offset some of that risk that you might get with a singular market, and afford you that new opportunity like we've been talking about. I mean, equities could be up, down, sideways tomorrow, and the movement in the spread isn't going to give a crap about that. It's going to move on its own. It's its own unique occurrence. But yeah, people always think about pairs trading or anything that is a step beyond purely stock picking or speculating on outright futures markets as being, I've got to create this whole other sense of mechanics. No, take your same mechanics, but just reduce those expectations down to something realistic, which is here about 50% of those outright markets.